Hello friends, hope you're doing well. Chris Lee, CPA here, back with another video for you. And today we are going to talk about the generation skipping transfer tax. So this is a tax that is applies to when there's a generational wealth transfer that you're planning for, and this applies in tandem with the planning that goes with gift and estate taxes. So it's less familiar and it's a little bit more confusing, and because you're thinking multi-generate, like 2, 3, 4 generations down the line, like what might happen. And so when we talk about generation and skipping transfer taxes, we're looking at transfers of assets that go more than one generation below you. So we have to think about what happens in tandem with the gift and the taxes and the generation skipping transfer tax. So we'll go ahead and hop into it. So the generation skipping and transfer tax is a federal tax that on the transfers of assets to individuals that are more than one generation below the transfer. Think a grandparent to a grandchild. So this fundamentally is defined as someone that's more than 37 and a half years younger than the transferor. So that's what's considered one generation below. And it is taxed at the same tax rate that applies to gift and estate taxes. And that's, 40% at this point, now that we're in 2026. So this was implemented in 1986 to prevent wealthy families from avoiding estate taxes at death of each generation through using the use of ongoing trusts, or sometimes referred to as, dynasty trusts and that sort of thing. So prior to the implementation, assets could be passed down to multiple generations, avoiding the estate taxes of each individual tier of beneficiaries along the way. And so it's kind of important to understand that it's a separate system in addition to the gift and estate taxes, and they run, parallel to each other at the same time. So when you're planning for one, you got to plan for the other as well. And so with that, they have very similar annual exclusions and exemption amounts. So that is to say, when you have, the annual gift exclusion amount of $19,000 that applies now, that same exclusion also applies on the generation skipping transfer tax side. And then and that same concept of exclusions and gift splitting and all those sorts of things of how husband and wives can split a gift for each having their annual exclusion, that can also be done on the generation skipping transfer tax side. So the same limits currently apply. So although technically they could be decoupled and you could see different amounts on each side, that's currently not where we sit, and that's not exactly what we expect to see. So the annual generation skipping transfer tax exclusion is $19,000 currently. And then on top of that, every U.S. resident also has a lifetime generation skipping transfer, also referred to as GST exemption, of $15 million for the single. That ends up being a $30 million combined amount for a married couple. And so what that is to say, a married couple could transfer a lifetime total of $30 million to skip persons without having to pay generation skipping transfer tax. However, you need to understand that transfers to a skip person may be subject to both gift and estate tax and generation skipping transfer tax. So you have to remember that these systems are running parallel, and that they could be triggered at any time, and that when you make a transfer for estate or gift tax purposes, you have to by election also be making a transfer for your GST purposes. So again, this is taxed at 40%, just like you would see on the estate and gift tax side. So it's important to understand that, like, while you're planning for both of these, that you're applying all of these elements correctly. So what triggers a generation skipping transfer tax? And so this can come in three forms basically. So the first is when assets are transferred from one individual to quote unquote a skip person, anyone 37 and a half years younger than the than the transfer. And this can be done either directly to an individual or through a trust. So for direct skips, the transfers or their estate pays the tax at the time the transfer takes place based on the value of the assets received by the transferee. So it's the transferor that's responsible for the tax. If it's otherwise, not, subject to using up an exemption. So once the exemption is used up, all subsequent transfers end up using paying tax on that, similar to what you see on the estate and gift tax side. So when it comes to, a second one, so the first is direct skips. The second are taxable distributions. So you can have an irrevocable trust created, and a distribution of income or principal is made by the trust to a skip person. And that can create, GST consequences. So imagine you have a trust that was set up for your child, your direct child, say, let's call it Susie, okay, and her Susie and her children. And what happens when you make a distribution to the children of Susie during her lifetime? So if Susie's mother did not apply her GST exemption to the assets she transferred into the trust, this would be, a taxable distribution that might be subject to GST. So the third is a taxable termination. So say you form a trust, and that trust has, your direct child as the beneficiary, and once that person passes away, it goes to their heirs, according to the terms of the trust. Well, if you don't apply the GST exemption on the front end of the transfer, and the child passes away, and all of a sudden your grandchildren have all of these assets, and the assets weren't, exempted by using the GST exemption, then the subsequent transaction could end up being what we call a taxable termination. The trust terminates. Maybe it's not multi-generational, but on the death of the initial beneficiary, it goes to the heirs, and there was no GST exemption applied. What you'll see are those assets would potentially be subject to GST tax. And so say that trust, after the beneficiary passes away and it's going to be distributed to beneficiaries, it's worth $5 million, 40% goes away, 40% tax. All of a sudden you've got a $2 million tax that's taxable to the trust that must be paid prior to those assets being distributed to the beneficiaries. And so that's where you can have some issues. A taxable termination basically means that the only remaining beneficiaries are, basically there are no non-skip beneficiaries left. That's when you can trigger it. It can also occur if there's maybe like a charitable remainder interest in a trust, and then the beneficiaries are and then the other beneficiaries are, heirs. So Susie dies, you've got maybe 4 heirs. 3 of them are natural persons, one's a charitable. The portion that goes to the natural person could be subject to GST if the original exemptions weren't applied. So when it comes to thinking about your GST, in order to avoid the tax on the initial transfer, an individual is going to need to allocate their GST exemption. So they're part of their 15 million or 30 million to kind of absorb that. And then once that's used up, then you start worrying about the actual tax payment. So you can use the GST exemption, both outright transfers as well as transfers in a trust. So you can do it either way. And the allocation of this exemption is generally reported on the gift or estate tax return. So that would be on the 709 for gift transfers, or you can do it on the 706. It's important to note that when the GST exemption is allocated to a transfer in a trust, any growth on those assets to which the allocation was made is subsequently sheltered from the GST tax in the future. So you can have a child, maybe Scott, that establishes an irrevocable trust for the benefit of his grandchildren and future generations, funded with $10 million. And he can allocate $10 million of his GST to the transfer. If that trust subsequently grows to $20 million, the entire trust would remain GST exempt. So Paul only used $10 million of exemption to be able to shelter what turned into $20 million of assets. So that's fundamentally the way that you can do that. So when it comes to reducing generation skipping taxes, it's, you know, outright gifts are the simplest option, and making sure, you know, they're under, you know, the annual exclusions. However, they're kind of small when you're relative to like how certain kinds of wealth can compound. So there are ways to reduce these taxes, which can be, you know, making sure that there is some beneficiary that is a non-skip person that is, you know, associated with the trust at any given point. That's one way to, you know, trusts or the asset to ensure that you're not ever skipping. So that's one way to do it. The second are, you know, super funding, you know, contributions to 529 plans. And then also you can use, you know, what are called dynasty trusts. So dynasty trusts are a wealth transfer strategy to create, you know, irrevocable trusts that incorporate, you know, asset protection and generation skipping tax strategies. So they're they're referred to as dynasty trusts because they're designed to last indefinitely. However, it's important to know that some states limit the number of years a trust may be in existence. So you have to make sure you're understanding the state statutes on that side. And they're typically designed to provide for a wholly exempt trust by the allocation of the transfer's GST exemption to all transfers made into the trust. So once a dynasty trust is exempt from GST, the distributions and terminations will not be taxable events for the GST either. So when you're looking at trusts and you're thinking about GST, you have to understand what portion of this trust is, you know, GST protected versus not. So that's where you look at how the assets came into the trust and if you allocated your GST to it. So that's an important thing to think about when we're doing this sort of planning. So all of this is to say is to understand that in it, with the conversations of multi-generational wealth planning, we need to be thinking about estate and gift taxes, but we also need to think about generation skipping taxes. A lot of grandparents do have in mind for their grandchildren and leaving something for them when they're doing this planning. So it's important to understand what that might look like and you know, have that GST conversation alongside the estate and gift tax conversation. So just know that it's a complex world. So it's a complex to think about, and so it's important to you know, consult your, you know, estate planning attorneys, tax professionals, and all those sorts of things as a group to understand what are we looking at and devise the best plan for a transfer of wealth. So I'll leave that to you. So if you need any direct consults, you'll have my information in the bio, and I'll have a new video for you soon. Take care.